my pleasure to be a guest.
Well, let's jump right in. What are the implications of the recent Greek default announcement? How does this inform your greater assessment of the macroeconomic picture?
Personally, I think that the Greek issue has been completely overplayed and misinterpreted. Say, the climax of the peak issue was in, say, October, November of last year, and everybody was very bearish, and what happened, because of the bailout of Greece and so forth, the markets rallied very strongly. We're up more than 25% from the October 4th low, when the S&P was at 1,074. So I think that the Greek issue is not market determining. In other words, the market focuses on other issues that are more important.
So the Greek issue, it's not a big issue because the amounts involved, or because it's already been priced in, or why is it not an issue?
It's been priced in because, don't forget, from the March 6 lows at 1,000 and something on the S&P, 1,066, from the March lows at 666 on the S&P, we went up to 1,370 on May 2nd, 2011. Then we dropped to 1,074 on October 4th, and then we rallied again. So the drop from 1,370 in May 2011 to the low in October of 1,074 already discounted the problems in Greece.
Okay, so I'm noticing that I'm not a huge believer in holding of stocks in general, equities at this point. I think you've noted that equities would be a good place to maybe survive or hide out from the coming inflation. So if we're looking to preserve our purchasing power against inflation in the future, and I want to get to some other data around that in just a minute, I'm interested in your rationale for being in the stock market at this particular point in time. You've also noted recently that you think that there's rough times coming ahead, that maybe equities are overbought. What's your general position on the stock market right now?
Well, basically, the stock market has rallied very significantly, and we're up more than 100% from the March 6, 2009 lows. So we're no longer oversold or undervalued. We're fairly valued if you take current earnings. But the problem is that maybe earnings are inflated and that earnings will decline. And so maybe the prospects for stocks are not particularly good. Equally, if you look at different asset classes, say you take real estate, equities, bonds, corporate bonds, government bonds, commodities, what is the best place to be in a disaster scenario? And in my view, probably by being in equities, you will not lose everything. You will lose maybe 30-40%, who knows, in a disaster scenario. But in government bonds, you may lose everything because governments may default. So all I'm saying is, the more bearish you are about the world, about social conditions, geopolitical conditions, the more actually you should be aiming at equities, because companies usually survive. They survive with less earnings, but they survive. Whereas governments, it's up to them to default. And so I'm not entirely out of the stock market, although I think that we may have a significant correction coming up in the next 3 months.
So with the possibility of a significant correction, let me widen out just a little bit further, though, into the larger macro view, because you note that sovereign debt has a chance of defaulting, where you could actually get wiped out, Greece being an example of that.
Correct.
Maybe Portugal coming up next, Spain, Italy, someone. I'm looking here at a chart of 8 central bank balance sheets tracked from 2006 on.
Correct.
And I know that they collectively sum up to around $5.5 trillion in 2006, and that by the end of 2011, they total $15.5 trillion. So that's $10 trillion of balance sheet expansion in just those 5 years. So 3 questions. What will be the impact of all of that? Can those balance sheets ever be unwound without calamity ensuing? And is this behavior going to continue? So starting with that first question, what's your assessment of the impact of this $10 trillion over 5 years?
First of all, I do not believe that the central banks around the world will ever, and I repeat, ever, reduce the balance sheets. They've gone the path of money printing, and once you choose that path, you're in it, and you have to print more money. So that will not happen. In other words, the reduction of the balance sheets of the central banks. So the price level will be higher than it was before the balance sheet expansion. Now, what is inflation? Inflation can manifest itself in wages, in consumer prices, in asset prices such as real estate, equities, commodities, and so forth. Art and collectibles. Now, the problem is that all these asset prices don't increase at the same rate at the same time. But it's a symptom of monetary inflation. And I think that, say, if you look at commodities, they bottomed out in 1998, and we're up substantially. They will not go back to the 1998 level. Will they go up in a straight line? I don't think so, because we have China and the Chinese economy slowing down and so forth and so on. So I think that we have to be very careful what assets we have to choose. But in general, I think that the purchasing power of money has diminished very significantly over the last 10, 20, 30 years, and will continue to do so. So by being in cash and government bonds is not a protection against this depreciation in the value of money.
Oh, absolutely. So you think you answered all 3 of my questions at once, which is great. So to paraphrase here, balance sheets are never going to contract, that once we're on this path of printing, we're always on it.
Actually, in my view, they will expand.
They will expand. So that's the continued printing. So then let me paraphrase Irving Fisher. I think we're on a permanent plateau of printing.
I don't think we are on a permanent plateau of printing. But you understand, if you start to print, it has the biggest impact. Then you print more. It has a lesser impact unless you increase the rate of money printing very significantly. And the third, money printing has even less impact. And the problem is, like the Fed, they printed money because they wanted to lift the housing market. But the housing market is the only asset that didn't go up substantially. We have bottomed out in many markets, I concede that, but across the board, real estate has not been affected positively from money printing. But what has been affected positively from money printing is the price of silver, is the price of gold, and of equities that have more than doubled from the lows in 2009.
Well, this is a very important point. If it turns out that once you're on the path of printing, you stay on the path, and that it requires ever-increasing rates of printing in order to have a similar impact on things. With this $10 trillion of money printing, it is by far the largest sustained effort of money printing we've ever seen, and arguably the world economy is limping along. It's in recession in multiple zones at this point in time, so it's not working. And this fits in with your thesis, which we're just going to continue to see more and more and more printing. Obviously, this story has to end somehow. We can't just continue to increasingly print at a faster rate with no impact without something happening.
That you say that it hasn't been working, in my opinion, is not entirely correct.
Yeah.
in the short run, it has been working to some extent in the sense that equity prices are up and interest rates are down, and so companies can issue bonds at extremely low rates. But every money printing exercise in the world leads to unintended consequences at a later point. And this is the important issue to remember. We don't know yet for sure what the unintended consequences are. For sure, we know one unintended consequence, and this is that the middle class and the lower classes of society, say 50% of the U.S., has rather been hurt by the increase in the quantity of money, in the sense that commodity prices, in particular food and energy, have gone up very substantially. And since the below 50% of income recipients in the U.S. spend a much larger portion of their income on food and energy than the 10% richest people in America and highest income earners. They have been hurt by monetary policy. In addition, say the lower income groups, if they have savings, traditionally they keep them in, say, deposits and in cash, because they don't have much money to invest in the first place. So the increase in the value of the S&P hasn't helped them, but it's helped the 5 or 10% or 1% of the population that owns equities. So it's created a wider wealth inequality and wealth inequality, and that is, say, negative from a society point of view.
Oh, I completely agree. And there's been, of course, savers have been punished with this 0% interest rate environment, in particular pensions and other large, long time horizon savers, as it were, are certainly also impacted.
Yeah, plus the pension fund industry, they have to have some returns. But when interest rates are at zero on cash deposits and on, say, long-term government bonds, on the 10 years note, say 2%, on 30 years 3%, they cannot meet their liabilities. So their unfunded liabilities increase very substantially.
If you were in their shoes, what would you do right now?
In the shoes of whom?
Say a fiduciary of, say, a pension fund trustee or somebody like that.
Well, I mean, I think personally that over the last 20 years, the financial sector has not criticized the Federal Reserve sufficiently. They should have attacked the Federal Reserve for printing money left, right, and center. But you understand, the financial service industry benefits from rising asset prices. So when you have a crisis, whether it's the SNL crisis or the tequila crisis in '94 or LTCM or the NASDAQ going down, they cheered that the Fed continued to print money because it lifted asset prices, and so their salaries went up and the performance fees went up and so forth and so on. So what I would do if I were the Fed chairman